Hello, everybody. Erica Millay here from Best Life Mortgage. Welcome. Thank you so much for tuning in. Um, Tonight, it is cold in Texas, really cold. So we have this freeze. So I hope everybody is staying warm and staying safe. I live right now in Kyle, Texas. Do a lot of my business between San Antonio and Austin, although I can do loans anywhere in the great state of Texas. So for those of you who are tuning in, I hope you're staying safe. Hope you're staying warm. Tonight, I'm going to talk about the adjustable rate mortgage. So these have not been super popular in the last couple years because the interest rates have been so low. So it made more sense to just do a fixed rate mortgage. But now, as interest rates start to rise, an adjustable rate mortgage might be a good product for you, depending on what your goals are and what your situation is. So tonight I'm going to demystify some of the things about the adjustable rate mortgage. So yeah, let's just dive in. Let me change my screen here so you can see everything a little bit bigger. Okay, so the aim is to help you completely understand the adjustable rate mortgage. It's also known as an ARM, how it works, when it can be useful, and just why to use this versus the fixed or other mortgages that are out there. So what is the adjustable rate mortgage? To answer that, you have to understand that a fixed mortgage means that the interest rate stays the same for the life of the loan. So a lot of loans can be a 10-year loan, a 15-year loan. The most common is probably the 30-year loan. But you can get, with some of my lenders, you can get anywhere in between. But that fixed rate, that fixed interest rate stays the same for the whole life of the loan. Really great option when interest rates are really low. Well, an adjustable rate mortgage, also known as an ARM, is just the opposite of that. The rate can fluctuate periodically. And this adjusting depends on the performance of a benchmark. So the benchmark determines whether the interest rate is going to go up or down. The benchmark that has been typically used in the past is called the London Interbank Offered Rate, also known as the LIBOR. But we're seeing a lot more shift sometimes lately to the SOFR, the Secured Overnight Financing Rate. But basically, these are two different indices, and there are other indices out there depending on which ones the lender uses, that will determine what that index, what that rate is going to be on an adjustable rate mortgage. An adjustable rate mortgage could also be, like I said, be known as an ARM. It's also called a variable rate mortgage, could also be called a floating mortgage. So what are the different types of ARMs? There are a couple of different options, really. You could even do an interest only, an IO ARM. And in this loan program, you'd only pay the interest on the mortgage for a specific time frame. This can last like 3 years or up to 10 years where you only pay the interest on the loan. And then once that time frame ends, you'd be required to start paying the interest as well as the principal of the loan. There's also a payment option arm, and this type of arm gives you several options within the loan program. These options typically include payments that cover the principal and the interest, payments that only cover the interest, and payments that cover like a minimum amount that doesn't cover the interest. But no matter whether it's an interest-only arm, a payment arm, all principal and interest must eventually be paid by the to the lender by a specific date. The last option is called a hybrid arm, and the hybrid arm offers a fixed period for the interest rate for a specific period of time, and then once that time frame ends, the interest rate will then begin to adjust. This is probably the hybrid arm is probably one of the ones that's going to be more common as the market shifts and some people might get away from the fixed interest, they might go to this hybrid arm with the fixed rate for a certain period of time, and then it becomes a variable or an adjustable rate mortgage. So how does the adjustable rate mortgage work? We just covered the many options of the arm. To figure out how the adjustable rate mortgage works, you have to understand the margin and the index. Now, we talked about the index. The index is what's decided by LIBOR or SOFR. There's different these different ways that the index is determined. But then there is also the margin. So the margin is the percentage point that has been determined by your lender. Basically, that is a set amount that stays the same throughout the life of the loan. So the margin is involved in determining the overall interest rate. So you have the margin plus the index. Now the margin stays the same, but the index is what adjusts. So if the index goes down, then your interest rate is going to go down. If the index goes up, then your interest rate is going to go up. Now, even though the rate adjusts over time, there are caps put into place to keep the interest rate from decreasing or increasing too much. The initial cap is the amount that an interest rate can adjust the first time it changes after the fixed period of time. The periodic cap is put into place to limit how much the interest rate can increase from one adjustment to the next. And then there's a lifetime cap or a ceiling that puts a limit on how much the interest rate can increase or decrease over the entire life of the loan. So let's take a look at the common ARM cap structures on the slide. And so this is how you would read this structure. Okay, so we've got a 2, 1, 5. So in this example, the 2, the first number, is your initial cap. So the interest rate can only increase by 2% on the initial adjustment. The second number is your periodic cap. So this means that at each adjustment after the first is limited to 1%. So, and then the third number is your lifetime cap. This determines the most the rate can increase or decrease, and in this case is 5%. So if your initial interest rate started out at 3%, then at the initial adjustment, it could go up or down 2%. And then at each adjustment after that, it could go up 1%. But over the whole life of the loan, the max it could ever go is 8%. Now, there are different types of ARMs. There are lots of different types of ARMs. I'm just going to talk right now about a 5-1, a 7-6, and a 10-1 ARM. So what that means, the first number is the amount of years that the interest rate is fixed. And the second number is how often the rate adjusts. So in a 5-1 ARM, that means that the interest rate will be fixed for 5 years. And then the interest rate can change once a year, every year after that, for the life of the loan. Same thing with the 10-1. If it's a 10-1, that means the interest rate is fixed for 10 years, and it can adjust once a year, every year, for the life of the loan after the initial 10 years. Now, the 7-6, that 6 is not years. So the 7 is the 7 years fixed, meaning it would be fixed for 7 years, but then it could adjust every 6 months after the initial 7 years. So which rate program is right for you? Choosing the right adjustable rate mortgage or other types of loan programs depends on a broad range of factors of the home buyer. So you have to think about what the current reality is, what's going on in the economic climate, what the rates are. Obviously, for the last 2 years, with the interest rates being at an all-time low, it didn't make sense to do these adjustable rate mortgages because your rate, you could fix that rate in at such a low rate for 10, 15, 20, 30 years. But now, as the interest rates are rising, it might make sense to look into an adjustable rate mortgage because you could probably start out with a lower interest rate than you could on a fixed rate mortgage. But it's going to just depend on each client's situation. So the best way to put all these factors into perspective is just to ask the right questions. And you're going to want to answer the following questions with your loan officer. How large of a mortgage payment can you afford today? Could you still afford an ARM if interest rates rise? How long do you intend to live in the property? This is a really good one because if you are in the type of job where you get moved around a lot, and you don't stay anywhere for 30 years and you might move every 5, 10 years, then it might make sense to do an adjustable rate mortgage. What direction are interest rates headed? And do we anticipate the trend to continue? Right now, we anticipate that the trend of interest rate rising is going to continue. A lot of things could happen to change that, but the state of the market right now is interest rates are probably going to continue to rise. With that, all that said, if you're considering using an ARM, you'll want to go through the numbers with your loan officer, determine if you'll be financially able to handle it if interest rates were to be maxed out. So after that 5-year fixed period or 7-year fixed period or 10-year fixed period, whichever it is, would you be able to handle it if the rates went up significantly? So who potentially benefits from the ARM? So remember we asked the questions we just went over. You want to keep all those in mind because every home buyer is in a different financial situation at a different moment within the economic climate and your local region. You actually benefit from utilizing an adjustable rate mortgage. If you're a short-term homeowner, like I said before, if you move a lot, this could be a good program for you. If you're an investor who automatically is going to do a cash out refinance every few years to tap into the equity of your investment properties, it might make sense to do an adjustable rate mortgage. If you know that over the next few years your income is going to significantly increase, then it might make sense to do an adjustable rate mortgage when you are prepared for that interest rate to go up, that you can financially support it. If you just know that like I said before, if you just know that you want to refinance, that you're going to refinance your mortgage often, makes sense. A third type of home buyer that may benefit from this type of program would be a home buyer that may want to use a low interest cost loan program to purchase a home, so that you know that you'll have asset, and if you know you're going to come into some assets to pay off the home in a short period of time. So for instance, you're expecting inheritance, you're expecting a big payoff from some other sale of a property later, anything like that, where you want to lock into a short term, like the 5-year, 7-year, 10-year ARM, because you know you'll be able to pay off that property completely. So there's a lot of different scenarios to look into to see if you're going to benefit from the ARM. The one thing I want to say is don't be afraid of an ARM, right? They used to get a bad rap a long time ago, or a lot of times people thought that an ARM was a scam, but really it's a great product for different home buyers and different investors depending on your situation. And with these hybrid ARMs, it's nice because there is that period that you are going to lock that loan into that fixed interest rate, and you know exactly when to expect that interest rate to go up or down. So anyway, that's pretty much the gist of what I have to cover about the ARM. Again, traversing all the intricacies of getting a mortgage, you want to make sure that you have a good loan officer to guide you, that's going to listen to you, understand your situation, and help lead you and think about your different options and point you in the right direction. An ARM is not for everybody. It definitely depends on your goals, your investment strategies, your financial situation, and what's going on in the market. So, if you choose me as a loan officer, I would love to help you out, or just look into the situation for you to see, to get you pre-approved to buy a home either way. But I can assure you that I'm going to really dig into your needs, understand what you need, what you want, and help you choose the right program that's going to help you meet all of your goals. So anyway, please reach out. Let me get my information up there. So if you have any questions about any loan program in general, adjustable rate mortgages, fixed mortgages, there's a lot of different, even with adjustable rate mortgages, you can do those in a conventional. We have some different investor products that could be adjustable rate mortgages or fixed interest rate mortgages. There's a lot of stuff out there. So if you have any questions, please give me a call. My cell phone number is 210-279-4392, or you can email me at ericabelay@bestlifemortgage.com. Or you can just shoot me a direct message or a comment in the chat below. We are streaming right now on Facebook, LinkedIn, and on YouTube. So don't hesitate to reach out if you have any questions. I work for Best Life Mortgage. We are a brokerage. That means that I have access to, I think, like 20 different lenders right now. So I can shop the mortgage for you. So you can do the fun part of shopping for the houses, right? So I can figure out which one of my lenders is going to get you the best rates, the best terms, to see if this adjustable rate mortgage is the right product for you. Best Life Mortgage is also a tithing company. We give 10% of our corporate profits to liberate kids from the shackles of human trafficking. And so we do that through a partnership with a company called Destiny Rescue, who basically does some covert operations and some counseling and some different things to just rescue kids from these horrible situations. So I'm proud to be part of a company that does give back. And we're called Best Life Mortgage for a reason. We want all of our clients, we want all of our partners to live your best life. And we want to be a part of helping you get there. And we want to help other people live their best lives. So thank you so much for tuning in. If you have any questions, please, please, please reach out. Stay safe, stay warm. It is cold and icy out there. So I wish the best for everybody and their family. Thank you.